waiting for the market, at least in the United States, in Europe, you know that here, well, inflation is going down and also the economy is not doing very well. Gonzalo Cañete, Head of Global Market Strategies for TFX Connect, good afternoon.
Good afternoon, how are you?
Well, upward movement for the dollar, therefore downward movement for the euro on an inflation data that has been significantly bad considering what the market was expecting, which was already to see that 2%.
Yes, right. And as the other colleagues have said, there have been different Fed officials who have been warning about this for weeks now. We have said that, in fact, I think the Federal Reserve is playing the game of ambiguity as it always does. That is, there is a plan which is to cut rates. Just a few weeks ago, it was discounted that that cut would come by March. And now it seems that I had, for example, and I have shared on networks now, the 10-year bond with that pattern that is doing extremely, it's a breakout of an inverted brocada sombro. In the 10-year bond, that looks like it's projecting it towards 425 or 450. In other words, the charts, the markets are discounting that this rate cut is not going as planned, and therefore the Fed, once again, is playing the lottery to see if it can get rid of the problem without knowing very well which factor is determining whether it is against the inflation rate or not. Last Friday, we were talking, especially on Business TV, about the inflation risks of the PPI indicators, the producer price index, and precisely what we are seeing is that now, under surprise, and as more than one had said, this is picking up. I'm pointing out what a colleague had also commented before, the data of the US economy was sufficiently positive, or else it is incompatible that both scenarios exist. A deflating inflation with extremely good US data, a very strong labor market, very robust, a growth rate of 3.3% of QIV of last year. In other words, there is a series of data that are incompatible with a deflating inflation, and therefore, what we see is that it had to break somewhere. And that discount that the market had made, it seems that the rate cut is expected by the market rather than by the Fed, as we are seeing now.
Where do you think the error lies? Because the estimate was at 2.9 and it has come out at 3.1. It is true that it is 0.2, but generally speaking, of course, when there is such a big difference between the estimated figure and the final figure, and then the market sees such a significant drop that in reality can only be explained because we compare it with expectations and not with the previous figure. It makes me wonder where the error of those who make these estimates lies and what they did not take into account that has finally happened so that inflation has risen more than they expected.
Evidently, I suppose the projection of some of the items they were estimating has not been in line with the result. That is to say, those projections that they are making estimate a series of price evolutions. And this is like when we use technical indicators, which are all based on mathematical formulas and on the arithmetic or geometric progression of certain variables, which then do not end up working out. There is a point, even if this is unfortunate for many, financial markets are not an exact mathematics, unfortunately, because all the econometric modules that we can work and develop over the years do not seem to be able to predict exactly the result that the market takes. And precisely for that reason, it is a highly speculative market, because nobody has the absolute truth nor the formula or the equation that allows us to determine exactly what is going to be the value of this type of assets. Therefore, I insist overvaluation or undervaluation of some of the parameters within the formula.
Gonzalo Cañete, as always, thank you very much for joining us in this special on US CPI inflation. Have a good afternoon.